Hey folks, Dan Frio here, the Mortgage Update. Thanks for tuning in. Today I want to talk about interest rates, how to find the best rate out in the market without going crazy, and how to compare different offers. Because what you're going to find out is, one rate might be higher than the other, but then when you start adding all the fees, and especially a lot of junk fees and things like that, it could really add up. And then, how do you really compare? What's the best way to say, okay, should I pay points? Should I not pay points? Things like that. And I'll discuss what points are. But if you would, I'd greatly appreciate if you like my videos, please comment below, as well as subscribe, and then click the little bell button there. So anytime I post a new video, hopefully they're informative to you. You'll get an alert. You can check it out. Please share it with friends, family. If you're a realtor, share it with your other coworkers and clients. But let's get on to it. So the first thing that you're probably going to do in most cases is you're going to Google and put in, mortgage rates or the best mortgage rates around or something like that. So let's see what happens. You get this chart, okay? And then you start looking and saying, okay, this one is 4.1, this is 4.2, this is 4.25. Here's my APR. What in the world is APR? Here's all this other stuff. You scroll down and this rate's going to go from 4.1 to probably 4.625, 4.75 with all kind of different APRs and fees. You'll see fees here, fees there. How do you make sense of all this? Have you ever heard of this place? Please be very cautious when you're doing this. The reason being is a lot of times in here, or probably most of the time when they're posting here, this is by far the best possible scenario that you can get for a fixed rate mortgage. Like in this case, it's a 30-year fixed rate. So if you're a marketing person, what are you going to put on here? The actual rate, which in the next few slides I'm going to show you is when you call in, there is no such thing as today's 30-year fixed rate is X. And, there's all kind of components that truly affect your interest rate. And I like to always say they're a la carte. But let's get back to this. And I don't know if this is a good thing or a bad thing, but have you ever heard of Sabonic Financial, Commonwealth, Box Home Loans? I've done this for 29 years, and I can honestly say I've never heard of one of these. But they can't really publicize on the internet without being able to offer this program. But again, this is by far the most qualified person ever might be able to get that rate. Okay, so let's really dig into rates and see how you actually figure a rate, because like I said before, there is no true, bam, that's if you call in and say, Dan, what's your 30-year rate today? If I just spout out a rate, that rate is going to be a guess. And let's get on to it. I'm going to show you here an actual or a true rate sheet that we get from lenders, and I am a mortgage broker, so I'm set up with probably about 21 different lenders, and they're mostly all wholesale lenders. And there's other videos that I have in regards to that. So again, if you would subscribe below, you can check my channel. You'll be able to find, different components or different videos that kind of fill in a lot of these blanks. So let's get on to a rate sheet. When I get a rate sheet in the morning, this is what I'm actually seeing, conventional rates. Now in this particular scenario, this is an elite program. So this is for people that are probably in 740, 780 credit scores, okay? So when you go through this section, let's focus right now on we're gonna look at a 30-year term. So this is a conventional loan. It's not an FHA or a VA or USDA, it's a conventional loan. And again, I got other videos that will explain the difference between conventional, FHA, VA, USDA. But let's go over here. So here is the 30-year rates right now, okay? What the minuses are and the pluses, or the non-minuses, I guess, is let's say you fit to a T with no adjustments to this rate, you fit at 3.75. However, to get that, there is a 15-day lock, a 30-day lock, and a 45-day lock. Basically what that lock means is you have to close and fund your loan within 30 days. So if I lock your loan today, you have to close and fund your loan within 30 days. So let's get down to the pluses and minuses. So at 375, if this is a plus or it does not have a negative in there, that means you owe that amount of money. So to make it simple, we're going to say this is a $100,000 loan. Okay, so at 3.75, you would owe $765 in discount points or points to get that rate. Okay, let's move up to 4%. You'll see a negative. The negative is basically a rebate back to you. Think of that as a rebate check or a coupon that you get. So at 4%, if it's a $100,000 loan, you're going to multiply that by 0.55 or 522. You're going to get a rebate for $522. So this is how we, as well as a lot of other places, will say, you know what, we can do a loan for you at absolutely no fees. Okay, and we're going to go through fees in a couple more slides, and I'm going to go through the most common fees, and I Googled it, the most common fees on a mortgage. So we go through, and let's just say the most common fees are $1,000. Okay, so what we could do is, in this case, you'd get 3.75. Again, remember we said you would pay points of $765 because it's that times your loan amount. We're using 100,000 is our benchmark. So you'd owe $765 plus the $1,000 in fees that we talked about. So you'd owe $1,765. So if we move up to let's say 4.125, you're going to get, let's take the $100,000 benchmark, multiply it by 1.014%, you're going to get $1,014 back in a rebate check. Okay, so basically, remember we said your costs are going to be $1,000. Well, you're going to get a rebate check for $1,014. So basically, that loan is free. It didn't cost you anything. So you went from owing $1,765 here to you owe nothing here. So that's how we do it to get you a no fee or no cost loan. Banks aren't doing it out of the goodness of their hearts. There are expenses involved to do loans, and this is how we do it. And you can move it over to a 20-year, a 15-year, and a 10-year. So it works the same each way. So now let's go, and remember I said there is no specific 30-year rate. And what I said is everything is a la carte, and I'm going to show you how this all works. And it might be a little confusing, but stay with me. So let's go to the next screen. Here is all the a la carte items that I spoke about. So your rate gets affected via your credit scores and what we call your loan to value. And loan to value is the loan amount divided by the value of the home. So loan to value. So you figure that out. And let's say, for example, again, we're using a $100,000 loan, and your house is worth $200,000. So 100 divided by 200 is 50%. So you would be less than 60, so you would be in this category. Now, what is your credit score? And your credit score, let's say, is a 740. So right now we have a 740 with a 0 adjustment. Again, this is, and you'll notice here, this says pricing adjustment. Okay. Now, are you getting cash out or are you not? Let's just assume you're not for simplistic reasons. But these are adjustments, again, based on loan to value and credit score, what the adjustment would be. And then there's a whole slew of other categories here. So again, these are all the a la carte items. But for simplistic reasons, let's just say you have a 740 credit score, you don't want any cash out, and you have no adjustments here. Just for simple. How does this work? So 740, you have no adjustment here. You're not getting cash out, so there's no adjustments. You have no adjustments. So we go back to here, and you have no adjustments. This is where the adjustments come. So again, if we go 4.125, you're going to get a free loan because your costs are $1,000. Well, let's go over here just for another scenario, and let's say you have a 640 credit score and you are at, well, we'll just say, we'll stay in the same category. You're at a 640 category and you're at that 50% loan to value we talked about. So you're going to get an adjustment to your price of 1.25. So remember that 1.25 is an adjustment, and that's a bad adjustment. It's a positive. So we go back here and we say, okay, at 4.125 we were free initially, but now we got to take 1.25 away from this. So now we're at 0.24 that we owe. Okay? So now you're at 4.125 and you owe 0.25. We'll round it to 25 to make it simple. So now you owe $250 along with your fees of $1,000. So now you owe $1,250 to get 4.125. So that's what I mean by a la carte. And if you have a kind of a low score, a high loan to value, and you're getting cash, so let's say example, you have a 640 credit score and you're at 80% loan to value. You move over here and you have a 3.75 adjustment. You're getting cash. You have another adjustment of 0.268. So that comes out to 3.75 plus 2.625. That adjustment is 6.375. We go back to our rates. It's not even on the, you can't even do it because we'd have to take 6.375 away from this number, or add it to that number if you want to kind of make it make sense that way. You'd owe like 2.5 points. So you get 5% and you owe 2.5 points. So $2,500 plus your $1,000 in fees, $3,500. That's what I mean by a la carte. So these are all factors involved in your interest rate. So there is no, you can't, it's hard to go back and say, well, today's rate is 4.115. For what? You don't really know what you're getting. You can click more details, but you're probably going to be thoroughly confused. So let's move on. If you're paying points, what are points? Points are basically prepaid interest. So 1 point is 1%. In our case, we're using 100,000. So 1 point or 1% of 100,000 is $1,000. So I'm going to show you 2 slides. You can focus on those. You can freeze them to give a comparison of what it would look like, you know, based on payments and the duration of what your balances is and how much is going to principal and interest and things like that. You can check these out, 4.25 versus 4.5. But in most cases, I don't have my clients pay points because most of the time points, their break-even point is 5, 6, 7 years or a little bit further out. The average loan is in effect for 7 years. So if you did anything prior to 7 years, it probably wouldn't make sense to pay points. So the next screen, this is, I Googled mortgage costs for Illinois. This came up with Chicago. These are the customary charges for all mortgages in Chicago. Let me go through something though. Origination points, I don't charge any. Commitment fees, I don't charge any. Document prep fee, there is one at the closing. Broker fee, we don't charge a broker fee. We don't charge a processing fee, and we don't charge an underwriting fee. So you have to shop. Those costs alone come to $386, $370, $868, $857, and $525. I could have just saved you $3,000 in costs. So please shop around. These are average fees. So most people on average are paying $3,000 more than they need to. The easiest way, here's the trick of the trade. Ask for a loan estimate. Go to page 2. Go down here in your costs. This would be your costs less any lender credits that you would be getting, and that is that rebate check that I spoke about at the beginning. And this will tell you exactly between that and if you are getting a lender credit, to track that from that, and that's your costs. So that's probably the easiest way to figure that out. Loan estimate, page 2. So I greatly appreciate you watching my video. If I can be of any help, please reach out to me at themortgageupdate.net. You can call me at 630-338-1160. And again, please don't forget to subscribe below. Thank you so much. Pass this on to friends and family. God bless you, and have a great day.